Hey guys, welcome to my channel. Today I want to go over one of the hottest topics in real estate right now, interest rate buydowns. Everyone wants to get their interest rate lower, but what does it mean to actually buy down your interest rate, either permanently or temporarily? How does it actually work? Are there implications, negatives, positives as the buyer or the seller? If you're interested in learning more about this, this is the video for you. All right, so in simple terms, an interest rate buydown is paying interest upfront at closing to lower your rate moving forward. There are two types of options you hear about when you hear about people buying down their rate. Okay, so there are temporary buydowns and there are permanent buydowns. In a temporary buydown, right now you will hear this as a 2-1 buydown. This type of buydown is paid by the seller. The buyer does not contribute to a 2-1 buydown. In a 2-1 buydown, say your fixed rate is 6.5%. The first year, your rate will be 4.5%, 2% lower, all right? The second year, your rate will be 5.5%, 1% lower. And then in the third year on, your rate will be that fixed rate of 6.5%, all right? So to determine what the seller will have to contribute in a 2-1 buydown, your lender will take the rate savings from the first 2 years, 24 months, add that all up, and that is what the seller will have to contribute to a 2-1 buydown. So this is all a case-by-case scenario in terms of how much the seller will have to contribute based on your lender, your loan amount, and the current rate, all right? Essentially, the seller will pay the difference in your rate up front for the first 2 years. That money will then go into an escrow account and be used monthly to make up the difference, and then you will pick up the full monthly payment, principal and interest in the third year. You will see this scenario used a lot by builders or really motivated sellers, or if a seller is trying to get a buyer off the fence, right? Because it's a pretty enticing offer. Now, pros and cons of a temporary buydown. Pros for a home buyer. All right, so the lower monthly payment that you'll see in the first 2 years will make it possible to afford a little more house. Also, if you're banking on rates lowering in that third year, you could potentially refinance and never have to pay that full fixed rate amount. But this is all speculation, as we cannot accurately predict what rates are gonna do in 3 years, right? But if they continue to go up, then you've saved in the first 2 years and then you remain at a lower than market rate in the third. Now, cons for home buyers. You really have to be careful and be sure of your financial situation to make sure you are going to be able to afford that full monthly payment upon the third year, or else you may be stretched so thin that you have to sell. Nobody wants that. Pros for sellers, all right? So offering a 2-1 buydown can be a very enticing offer for buyers and may persuade some buyers to go with your home over another, all right? Now, cons as a seller, this option is an upfront cost to you. And the higher a buyer's loan, the more you're going to have to put up for the buydown, lessening your net proceeds in the sale, all right? Now, let's talk about a permanent buydown. Permanent buydown is when either the buyer, seller, or a combination of the two contribute money at closing towards discount points on the mortgage to buy down the rate permanently for the life of the loan, all right? First things first, let's explain what a mortgage point is. Mortgage point or discount point is 1% of the loan amount, all right? So say you're buying a home for $450,000 and you're getting a loan for $400,000. So 1 point would be $400,000 times 1%, $4,000. 2 points would be $400,000 times 2%, $8,000, all right? An important thing to note here is that buying down your rate by 2 points does not mean your interest rate is lowering by 2%. Those are not interchangeable terms, okay? But what happens in this scenario is that, again, this is all case-by-case scenario based on your lender, current rates, and your loan amount, all right? So always talk to your lender. But essentially, if you are doing a 2-point buy down on a $400,000 loan. At closing, you will contribute $8,000 towards this buy down. Your lender will then determine what your new rate will be with that given contribution. This is not something your real estate agent can quote because it all depends on your lender, your rate, and the loan amount, all right? But just as an example, okay, if your loan was $400,000 at 6.5%, and you put up 2 points, your rate may lower to say 6.125%. This will be your new fixed rate for the remainder of your loan. All right. The most important thing to note and discuss with your lender is your break-even point on a permanent buy down. You need to understand how many months it will take you to recoup that initial investment to determine if it's a reasonable and smart financial decision. So, for instance, in the previously mentioned scenario, say contributing $8,000 upfront saved you $80 a month on your payment. $8,000 divided by 80 equals 100 months. So your break-even point is 100 months or just over 8 years to recoup your investment. So if you know you're not planning on staying in that house for 8 years, this would not be a financially smart decision. Again, just as an example, it is all a case-by-case scenario. In your case, it may take much less time and be beneficial. As the market has shifted and sellers are having to work and negotiate to get their homes sold again, we are seeing seller contributions come back, all right? You will often see this as seller is offering XXX amount of dollars towards closing costs or buying down your rate. So when you're deciding how to use these seller contributions, you need to thoroughly weigh your options with your lender based on your specific circumstances, okay? So say you are planning to stay in this house for only 2 or 3 years. It may make more sense to negotiate a 2-1 buy down with the seller as opposed to using those funds towards a permanent buy down. Or say using those funds towards a permanent buy down is only going to save you $70 a month and take you 6 years to recoup your investment, and you don't plan on staying in that house for 6 years. It may make more sense to use those funds towards upfront closing costs, keep your rate the same, and hopefully refinance down the road if rates lower. It is truly all a case-by-case scenario, and there is no one-size-fits-all approach to negotiating your deal or maximizing your financing. That is why the relationship between you, your lender, and your real estate is of utmost importance when it comes to getting you the most advantageous deal in your market. Thank you for joining me today. I hope that you found this video informative and helpful. Please like and subscribe to my channel. As always, I love to hear from y'all, so please drop a comment in the comment section below. If you have any ideas on future videos from me, I always love to hear that. I hope to see you back next week.